Hi, everybody, and welcome to TradeStation. This is Don Prattle here in the Chicago office of TradeStation, and with me here in our location is David Lerman from the CME Group, and he's going to talk to us today about why stock traders should consider trading futures. David will be sitting at my desk, so it'll look like I'm the brilliant one today, but no, that's not the case. This is David's presentation. Let me just go over some of the housekeeping. First of all, our presentation is for educational purposes only. All the symbols and all the trading ideas and everything we discuss here are for demonstration purposes. They're not recommendations. This presentation is not an offer or a solicitation of any kind anywhere where TradeStation is not authorized to do business. Active trading might not be suitable for everyone, and options trading carries a higher degree of risk and may not be suitable for all traders. The presentation today may not center on options, but we do want to make sure that you understand that concept. I've included in the chat panel some disclosure information regarding the characteristics and risks of the various classes that we trade here at TradeStation. Now, futures trading is not suitable for all investors, and it does involve the risk of loss because they are levered instruments or leveraged instruments, and because only a percentage of a contract's value is required to trade, it is possible to lose more than the amount of money deposited for a futures position. So traders should only use funds to trade futures that they can afford to lose without affecting their lifestyles. The rest of the paperwork here, I'm going to leave up to you and begin and turn things over in a minute to David Lerman. Now, I want to talk to you about the Market Insights blog, insights.tradestation.com. David Russell and myself and other contributors here from TradeStation have been making blog posts for months, and we have an awful lot of great content there that you may want to take advantage of regarding all of the asset classes that we cover here at TradeStation. One more thing. If you're interested in jump-starting your options trading, you can learn from the pros to trade options like a boss in Chicago on October 19th, 2018. Join us in Chicago here at tradestation.com/optionsstars. Join us at this webinar. At this all-day long seminar here in Chicago. If you're in the Chicago area or would like to be in the Chicago area on October 19th, join TradeStation. And now I'm going to turn the microphone over to David Lerman of the CME Group for a wonderful presentation on shaping your future using CME Group products.
Thank you, Don. And on behalf of myself and the CME Group, I want to thank TradeStation for hosting this webinar. And we've got a great crowd. We got over 100 people sign in here, and from all over the world: Italy, Spain, Panama, El Salvador, including most of the 50 states. So we appreciate the participation, and we hope I can almost guarantee you that everyone will walk away having learned something from this. We'll cover a lot of things from mostly a basic approach, but we'll get into the weeds a little bit too, because I like to challenge my audiences. So we're shaping your future using CME Group products. We're going to talk about CME Group products, but we're going to talk about just trading futures in general and why it's something you should consider. All right, so let's get rolling here. If I can just advance the slide, that would help. There we go. All right, so some of the things that we want to talk about is liquidity and diversity and capital efficiency and around-the-clock access and a whole plethora of other benefits to trading futures contracts. The number one that we're going to talk about is liquidity. Pound for pound, actually not pound for pound, but the liquidity of the major futures contracts is unparalleled. They're far more liquid than the stock market. They're far more liquid than the ETF market. If you look at Eurodollar futures or Treasury futures or the E-mini S&P 500 futures contract, they far out trade their cash market counterparts. So, and the reason why is there's deep liquidity. And not only that, there's around-the-clock liquidity, but we'll get to that in a second. So we have a tremendous amount of liquidity in the top futures contracts. Most of the active traders and retail traders out there trade the E-mini S&P 500 futures. They trade crude oil. They trade gold futures. They trade some currency futures. And they're all very, very liquid with the minimum bid offer spread, usually one tick. That's usually the minimum price fluctuation in a futures contract, one tick, whereas with stocks, it's a penny. But you can do billions of dollars in notional amount trades in some of our products and not move the market at all. Others are not as liquid, but in general, most of the active traders out there that trade our main products trade the ones that are most liquid, and there is no problem getting in and getting out. And there's usually not a problem getting in and getting out, even at 3 in the morning if you had to. So we're also we have a diverse product group. Most people that trade stocks, they're pretty much tied to the equity markets. So as a result, that's it. You're exposed to that one asset class. If the stock market's moving, great. You have a chance of making money. If the stock market is not moving, you have no chance of making money or less of a chance. The great thing about futures contracts is it lets you get into other asset classes because there's futures contracts on interest rate markets, currency markets, commodity markets like gold, energies, the grains and livestock and things like that. So there's a great diversity and a lot of ability to get into different asset classes, which is something you should learn about anyways. Even if you never trade futures, they're wonderful tools. They're great indicators for how the market may react, especially some of the overnight markets. They give you an idea of what the tenor is going to be like in the market when it opens here in the United States, and it's just good to know. Another thing, capital efficiency, and we'll review some of these as the presentation goes along, but capital efficiency, capital is precious here in the market, and you want to be able to use as little as possible and spread your capital around to different markets so that you can have a diverse portfolio. For example, the E-mini S&P 500 is about $145,000 notional value. You only have to put down around $5,500 as a margin requirement. So that's about 3.8%. Far less than the 50% you have to put down when you borrow on margin and do it in the stock market or doing ETFs, trading ETFs. So capital is very, very, very precious. And we had a seminar once many years ago when a gentleman stood up in the audience and he said, well, Dave, I'd really like to trade the E-mini S&P 500, but this leverage, I have to put $4,000 down to control $90,000. And that was the notional amount of the S&P back when we gave this seminar. And he said, it's a little bit worrisome, that kind of leverage. And so just for the heck of it, the seminar was in Orange County, California, where there's very, very high-priced houses. So we played a little game in the audience, and he was a go for it. And I said, just out of curiosity, where in Orange County do you live? And he said, Laguna Beach. So he played right into my hand perfectly, because Laguna Beach is one of the most demographically blessed places in the United States, with the average price of a house in multi-millions. And I asked him, I said, well, east side or west side of the Pacific Coast Highway? And he said, I can spit watermelon seeds into the ocean every day. And I said, okay, so suffice it to say you have an asset worth approximately $5 to $10 million minimally. And I told him, I said, well, just out of curiosity, how much did you put down? And he just started laughing. And he said, this is California. We put nothing down. And it was quite interesting. I said, well, how can you be worried about the leverage in a futures contract where there's very reasonable leverage when you put nothing down on a $10 million asset? And he says, well, now that you put it that way, that makes it interesting. So we talked after the seminar, and he got pretty comfortable pretty quickly, given that a little analogy. But that's the great thing about futures contracts. You have great capital efficiency because you only have to put down a small amount. You also have around-the-clock access. We'll see some graphs that show how good this is later on. But you have 24/6 access. Markets aren't open on Saturday. If you want to initiate a position overnight or get out of a position late at night, you can do so. In the U.S. stock market, there's pre-market trading, there's post-market trading. Very few individuals, though, have access to true 24-hour trading in the stock market. But in futures, our markets have been open pretty much 24 hours a day. Basically about 23 hours a day. There's about an hour downtime for system maintenance and uploading and downloading of orders. So it gets to the point that really you can do any trade you want, anytime you want, and that's a good thing. Unless you're extremely well wired, it's very hard to trade 24-hour basis in the ETF market or the stock market. I imagine that will change in the future, but for now it's very tough to trade overnight. A few firms allow complete 24-hour trading, but the futures markets, well, the foreign exchange market's been 24/7 for a long time. In the futures markets, we've had 24/7 access basically since 1992 when we launched the Globex trading system. There's some other benefits we'll get to as the seminar unfolds, but there's transparency, it's a pure direct market view, and there's tax advantages that we're going to talk about. All right, so let's get into a little bit more deeper in the weeds here in liquidity. And down at the bottom there, you see a little bit of a panel that shows the 6 or 7 contracts, the E-mini S&P, the E-mini NASDAQ, gold, WTI, which is crude oil, corn futures, and the 10-year Treasury note. Those are probably 6 of the most active contracts traded by retail traders or active traders. And it shows the bid and the offer. Well, it shows the product ticker symbol. ES is for E-mini S&P 500. Tells you the product. Tells you the description in terms of its expiration. A little bit of a dated slide. It's September 2018. They went off the board about 3 weeks ago. The quantity, they have a bid and offer and the quantity on each side. So you see 130. That means 130 contracts on the bid, and the bid is 2,787.00. The offer is 2,787.25, and there's 161 offered there. Now remember, this is a snapshot of liquidity. This is not continuous. This is just a snapshot at that time. I could have taken this 5 seconds later, and all these numbers would change dramatically. Some of them would be much higher. Some of them would be much lower. But the depth of order market and most of the contracts is pretty darn good. And unless you're a 1,000-lot trader, which only large money managers and hedge funds trade in those amounts usually, or you're a very large speculator, usually the market can handle liquidity. We have a tool too, which if I have time later on, we'll talk about it. We have a new liquidity database tool, and you can see exactly how much your order will move the market. So if you want to do 25 contracts, it'll show you how much it'll move the E-mini S&P 500 on any given day. You want to do 500 contracts, it'll show you how much through the depth of order book you're going to have to go through. So you can see the E-mini S&P 500. The E-mini S&P 500 is pretty liquid. It's 130 by 161. And if you look at the 10-year Treasury note future, it's 1,000 by 4146. So obviously Treasuries are extremely liquid. If we put Eurodollar futures up there, they'd be even more liquid. But in general, the E-mini S&P 500 is more liquid than 130 by 161. Going on down the line, the E-mini NASDAQ 100, it's 8 by 5. Again, that's a snapshot. It's usually much larger than that. Gold, 24 by 35, that's about right. WTI is probably larger than that most of the time. Again, if you use our new liquidity tool, you will you'll be able to see exactly how much. And you can go at any time frame too. You can see how liquid was it during the month of January. How liquid was it from year to date, the first 10 months of this year. So it's a good tool. It's free also, and it's on our CMEGroup.com website. Corn futures, incredibly liquid. This was taken at a time during the trade and tariff issues, and corn and soybeans were moving all over the place. Again, great trade opportunities in the marketplace. And it was 75 by 945. That's pretty darn good for corn. 945 on the offer is this would be a very large trade. Each corn futures contract's 5,000 bushels of corn, so that represents a whole heck of a lot of corn. And as we said, the 10-year note 1,000 by 4100. Incredibly liquid. Even the largest institutions will have no problem getting filled on that kind of trade. So that's obvious. Liquidity, sometimes people look at volume or they look at open interest, and that's two indicators of liquidity. But the real indication is how tight the bid-offer spread, how many contracts are bid at the bid, and how many contracts are offered, and also what the depth of market is. In other words, how many contracts are there below that best bid, how many contracts are above that offer. And that's where the real liquidity is measured. All right, another way to look at liquidity and what it means is we have the contract size and we have the value of the minimum tick. So with the E-mini S&P 500, to get that 139,000, you just take the price of the futures contract and multiply by 50 because that's the contract multiplier. So the notional amount when we made this slide was $139,462. The value of one tick The mini S&P moves in quarter of a point increments, 0.25, 0.50, 0.75, and then up to the next nearest even number. Each one of those quarter point increments is $12.50. So $12.50 divided by into $139,000. It's the cost of execution is 0.008. That's less than a basis point. It's pretty incredible. It's 8/10 of a basis point. Check that out on the stock market with some of the stocks you trade, and you'll see very few things trade that cheaply. The E-mini NASDAQ's even cheaper. The value of a tick's $5. The value of the contract's $144,000. It's not even a half of a basis point, 0.004%. Gold futures, again, pretty cheap, less than a basis point. WTI, which is crude oil, because it's a smaller contract size and the tick is $10, it's about a basis point and a half, 1.5 basis points or 0.015%. Corn is dramatically higher, but of course corn is a much smaller contract and it has basically the same size tick. So not the most accurate way to measure liquidity in corn, but the transactional costs are bigger because the contract size is smaller. And 10-year Treasury note is also incredibly liquid at 0.016. So the cost to trade these things is minuscule. All right, so we talked about the diversity of our product mix, the ability to transact well beyond the equity market. There's, like I said, there's the interest rate market, equities, the metals, energy, foreign currencies, and agricultural products. So interest rates, we have the long-term end of the yield curve, Treasury futures, we have the 2-year, 5-year, and 10-year, and also the 20 and 30-year Treasury bond futures. The 30-year Treasury bond would be the ultra bond. We have the energy futures, crude oil, natural gas, and gasoline. We have the equities, as we talked about, the S&P 500, NASDAQ 100, and the E-mini Russell 2000. And currencies, we have almost all the major currencies, the euro, the British pound, and the Japanese yen. And we have the metals, gold, silver, copper. We also have platinum and palladium. And agriculturals, we have things that grow, corn, wheat, soybeans, oats, and things that we eat also, cattle and lean hogs. So you can see there's a tremendous diversity to allow you to trade well outside the U.S. Stock market. Nothing wrong with the stock market. Everybody trades the stock market, but occasionally it gets really, really quiet. For most of 2017, it hardly moved. We had almost no days of a 1% move. So for traders, the lifeblood of traders is movement and volatility, and we didn't have a lot. As a matter of fact, there's low volatility in almost every asset class, but there's usually something moving. Now the stock market's moving, interest rates are moving, the energy markets are moving, everything seems to be moving, which is nice. It provides a lot more opportunities. This is a chart, a little bit more detail. It shows a sampling of commodity and financial futures contracts, and this is around the world. These don't all trade at the CME Group, but you can see the metals and the energy, commodities, FX, equities, and interest rates. You can see numerous futures contracts available to trade. Another thing about, we talked about this just a few seconds ago about the diversity. Why is diversity important? Because of cyclicality, or the cyclical nature of futures, plus, as we talked about, low volatility. You look at the chart on the left, January gold implied volatility for gold. You can see over the last few years, volatility has just come way, way down. It's pretty interesting. The same thing with NASDAQ over towards the end of the year and the beginning of this year, volatility came way, way down. Now it's gone up dramatically, but it helps to have a diversity of product groups because there are times when volatility is low in some products and therefore trading opportunities are far and few between. But there's usually something moving dramatically. There's always something moving. There's only been one environment, it was actually end of last year, the beginning of this year, where almost every futures contract, every asset class was either near historic lows or getting pretty darn close to historic lows. And here's another example of volatility and how it would affect a trader, because volatilities could be different in different futures contracts, but also the contract sizes of all the futures contracts are different too. So, for example, crude oil, it had 309 1% moves in the time frame that this was taken. I think it was the last 3 years, I believe. There's 252 trading days in a year. I think this went back 3 years at least, or maybe 2 years. I should get that data. I'm sorry about that. And that had 3% moves, which is pretty darn good for crude oil. But the value of a 1% move is $575, which is reasonable. You can make a profit on a 1% move if you're on the right side of the trade. Gold had only 109 1% moves, but gold is twice the size of the crude oil futures contract. So a 1% move is $1,264. So you have to reconcile volatility here. You have to reconcile volatility with the contract size, because sometimes a contract can have a lot of volatility, but if it's a very, very small contract, you won't get as much as a dollar value of a move. Copper, 220 1% moves, 25 3% moves. The value of the copper contract's about $70,000, $60,000. So it's $787. Even the S&P 500 was the quietest market in this 3-year time frame. Only 29 1% moves. Actually, someone just made a comment. We're seeing 1% moves in crude oil almost daily now. That's true. Now we are. That's not always been the case, though. If we updated this chart over the last 30 or 60 days, we'd see almost 100% days of movement of 1% in crude oil. Good point. Natural gas, 351 1% moves, and it's a small contract, so that's only $269, the value of it. But back to the E-mini. It was so quiet in 2017, most of 2016, and a lot of 2018. And only 29 1% moves, but it's such a large contract at 140,000 notional value. 1% move is 1,342. Even the mini futures is getting pretty large now because of this massive bull market we've had since the financial crisis. So always look at the contract value and look at the volatility, because the two do go hand in hand and they reconcile with each other. So. All right, so capital efficiency, putting your money to work. We're going to have an example here. We do an entire seminar on this, comparing the FANGs, trading in the FANG stocks versus the NASDAQ 100. Now, there's no doubt, I'm not going to sit here and knock the FANG stocks. You could have made a tremendous amount of money trading, Facebook, Amazon, Netflix, and Google. There's just some things we wanted to point out here. So let's just flip the page here. All right, so we're going to compare a notionally similar number of FANG stocks to the NASDAQ 100 futures, the E-mini NASDAQ 100 futures. The notional value of the E-mini NASDAQ is about roughly 144,000 at the time I made this slide. To trade the FANG stocks in equal amounts, we just took equal increments, $36,000 for Facebook, the same for Netflix, Amazon, and Google. Add it all up, it's 144,000. So you have a choice. You can buy $36,000 worth of each of the FANG stocks, and there's the quantity of shares you would need, 187 for Facebook. You'd only need 21 Amazon because it was such an expensive stock at $1,800, $1,900 a share. The regulation team margin requirement for the 4 stocks would be $72,000 because you have to put up 50%. Futures margin is totally different than margin in the stock market. In the stock market, you have to put down 50% and you borrow the other 50% at the broker loan rate, all right, which is subject to, well, it depends on your credit worthiness, the amount of your credit balances, various other things too. But the broker loan rate could charge between customer to customer and between firm to firm. So you have to put up 50% or $72,000 and borrow the other $72,000 to buy $144,000 worth of the FANG stocks. However, you can buy the one E-mini NASDAQ, the ticker symbol is NQ, futures contract. It's worth $144,000, but you only have to put down, at the time of the slide, $4,200. I think margin's gone up to around $5,500 now, $5,800, because volatility has crept in. Remember, margins are subject to change. Performance bond margin levels are subject to change. They can change on a daily basis. They can change on an intraday basis if there's enough volatility. Although we haven't seen enough volatility lately to have too many changes. All right. So what would you rather do? Well, a lot of people choose NASDAQ futures because I don't have this chart up with me. I didn't bring it with, but we have a chart that goes along with this in a different presentation, the 1-hour version of this. And it shows that the E-mini NASDAQ 100 futures trade about $64 billion a day in notional amount. If you add up all the FANG stocks and the QQQ ETF, it doesn't even come anywhere near 63 billion. I think it's about 20 billion. So the NASDAQ, E-mini NASDAQ futures trade 3 times more than all the FANG stocks put together and the NASDAQ ETF. So that speaks to the critical mass And it speaks to the liquidity in the futures contracts and the type of players that are playing in the market. There's a lot of large players. There's a lot of turnover because of all the things we talked about at the beginning of this webinar, that 24-hour trading, deep liquidity, very low transaction costs, and things like that. Okay, we also talked about around-the-clock access. So these two charts down here are very interesting. Again, they don't tell the whole story, but I'll fill it in for you. The one on the left, that's the one we're going to spend the most time on. That's the E-mini S&P 500 at the November 2016 elections. Very interesting thing. We've talked about this many times. That liquidity is great, but liquidity when you need it is even greater. And some people need liquidity overnight, namely Asian traders and European traders. So we have people on from Spain, we have people on from Italy, and a whole bunch of other countries in different time zones. So listen up. So this chart shows the election night behavior. This is after the cash market closed in the United States. And as you all know, Donald Trump won the election, but obviously. But going into the election night, Hillary Clinton had a 5 to 10 point lead in almost every poll. She had an incumbent president backing her. She had her husband was an ex-incumbent president. She had billions of dollars behind her, so it was a foregone conclusion that she was going to work. So it's interesting what happened, because people, even though Hillary had a distinct lead in the polls, people wondered. They wondered, there was still a small chance that there would be an upset and Donald Trump will win the election, and that would, inject a certain degree of uncertainty into the market. So interesting thing. So this shows when the polls close at 6 o'clock. By an hour and a half later, the market's dropping dramatically, and the E-mini S&P 500 is down a huge amount. It's down roughly 80, 90 full points, which is a lot. It doesn't move that in a week or a month in general, and it moved overnight. And there was great liquidity. You can get in and you can get out. But then an interesting thing started to happen around 9 or 10 o'clock when most of the polls were closed in the United States. The Dow was down the limit, 900 points. The S&Ps were down 80 or 90 or 100 points or something like that. And what happened next was nothing short of, well, I won't say miraculous, but quite interesting, intriguing to say the least. The very thing that people were afraid of that caused the market to plunge, or at least that's what the market pundits said. The talking heads all said, hey, look at this. We're afraid that Donald Trump's going to get elected, and therefore the market's plunging. Well, when it turns out he wins some of the states that he's not supposed to win, it looks like he may actually win the election. What does the market do? Well, it can't plunge anymore because of the limits, price limits, overnight price limits. However, it didn't have to worry about that because the market started a very sustained rally. And as you know, we're up about 45% since November of 2016. So it's been a really good move. But the whole point I'm trying to make here is that if you need to get in and you need to get out after the market hours, there's plenty of liquidity. If something happens in Asia or in Europe and you want to initiate a position, you can do so in the E-mini NASDAQ, E-mini S&P, just about any one of our futures contracts. Someone just added that current NASDAQ margin is about 61.50 for a position held overnight. He's right. The margin's gone up a little bit. It's changed in the last couple of weeks. It's changed a couple times actually because the NASDAQ's been moving up and down so much, and the contract notional value has also been changing. So yeah, and for positions held overnight, that's the initial margin is in force. But if you do an intraday margin, some firms will let you trade on less margin, significantly less margin. So thank you so much for pointing that out. This is, again, round-the-clock access, top-of-book bid-offer spread in ticks. So this tells you the bid-offer spread in ticks of all the major contracts at CME Group. The yen, the euro, and the Canadian dollar are all a little bit more than a half a tick, 0.6 ticks. That's because they move in half-tick increments. In our futures contracts in FX, we have half-tick increments, so they should be right around 0.5, and they're slightly above that. With the Canadian dollar, it's more like 3/4 of a tick. Which makes sense. So sometimes it'll be a half a tick, sometimes it'll be 1 tick, and it averages out to be about 0.75, 0.7 ticks. All the others, from corn to the treasuries to the eurodollars to copper and natural gas, are all right around 1 tick. Again, showing pretty excellent liquidity across the board. Same thing in Singapore, Asian time zone. Basically, one tick market and everything. Where you see those 0.6 or 0.55 ticks, that's currencies usually. Everything else is about one tick. So we not only have liquidity in the U.S. time zone, but in non-U.S. time zones, Asia and Europe, we have pretty good liquidity too. It's excellent liquidity, and that's why we have so much volume overnight. All right. But wait, there's more. Some of the other advantages, transparency. Almost all of our business now is conducted on the CME Globex system. About 90% of our volume is traded on a Globex matching engine. It's a central limit order book, so everybody knows the bid and offer. Everybody knows the depth of market, and it's not like the over-the-counter swap market where the only people that know about the trade are the two counterparties making the trade. In futures, it's different. Everybody sees the trade. It's kind of like the stock market. Everybody sees the trade too up on a quote system. It's a first in, first out algorithm, so it's an equal playing field to all market participants. It doesn't matter if you're playing in the biggest market in the world, which is Eurodollar futures and Eurodollar options. If you are first in, you have the same access as someone that's if you're first in with a 1 lot versus first in with 1,000 lot, you have pretty much equal playing field. There's a slight exception to that in a couple of our contracts that have an algorithm based on size, but in general, you will be treated very, very fairly. It doesn't matter if you're a gigantic pension fund or a 1 lot trader, you will be treated very fairly and equally. So for the CME Group's major products, CME is the main liquidity pool. There are not disparate markets all over the world on it. They trade on our matching engine, and that's it, and nobody else's. We do have agreements with certain other exchanges for certain products, but in general, our main products trade through our matching engine or CME Direct, a front end, but they all go through the CME Group clearing system and clearinghouse. Another great characteristic of CME futures or futures in general is the ability to express a pure market view. All right, the products are either physically delivered or settled to cash to an underlying instrument. They allow you to take a long or short position on almost any futures contract. So if you want to play crude oil futures are the best way to do it. Futures track the underlying crude cash market almost 99.9%. Intraday, that may be a little bit different. Some days it may be different. But in general, crude oil futures track the crude oil market, the WTI market. So I get questions, and some people say, well, if I want to play energy, should I just play Schlumberger or ExxonMobil or Pioneer or something like that? And it's like, well, you can, but there's not a direct correlation between the movement in crude oil and the movement in stocks. If there's a huge sell-off in stocks and crude oil is up $2 a barrel, ExxonMobil is probably still going to be going down. If the Dow's down 400 points, I'm sure it's going to take almost all the oil companies with it, even though crude oil may actually be going up. On a day-to-day basis, ExxonMobil's got a lot of operations, upstream, downstream, gas stations, refineries, a chemical division, all sorts of divisions, and they don't necessarily correlate 100% with the crude oil market. So ExxonMobil could travel in a different direction than crude oil over a certain specific period of time. So it's better to get a pure market view, do the futures, because they track the underlying cash market. The clearinghouse. This is the crown jewel of the CME and the most important part for a trader. They're always telling people about risk and risk management. It's also been said that if you don't have good risk management skills, the futures markets are not a place for you to learn them. But a lot of people take the opposite tack and say, if you don't have good risk management skills, the futures markets will hone them. And that's because of the clearinghouse and, of course, your brokerage firm, in this case, TradeStation. They will enforce certain margins. They will enforce certain risk mitigation procedures that we have in place, not only at the clearinghouse level, but at the firm level. And it's really important in futures. So the clearinghouse, they're the ones that clear all the trades, all right? They establish all the margin levels, all the initial and all the variation margins. They do all the mark-to-market settlement every day. Each and every day, sometimes intraday they'll do a settlement, but generally they'll move money every day, and if you make $10,000 trading in futures today, it's available tomorrow morning by the opening. It's one of the good things. The stock market's a T+3. You get a settlement 3 days later. The clearinghouse also debits and credits accounts accordingly every day. So again, every day that goes by, the clearinghouse makes everyone whole. They debit and credit accordingly every account. In the over-the-counter market, if you do a 5-year swap, things aren't going to be debited or credited until 5 years down the road. There may be some margin calls intraday, which is kind of or intra that 5-year period, within that 5-year period, but that was some of the problems during the financial crisis. There were some margin calls on credit default swaps that people couldn't meet, so the government had to bail them out. But we won't get into that. So if your risk management's not good, the clearinghouse and your FCM will impose it. So it's a good thing. You'll learn a lot about risk management because futures don't move any more than the underlying, okay? If the S&P cash market's up 10%, the futures markets are going to be up about 10% too. Where the risk is in leverage. You're only putting a small amount down, yet you still have the same percentage move in the underlying. And that's why you have to have risk management. Futures are not any more volatile than their underlying cash markets in general. It's just you only put down a certain amount. So it's leverage adjusted risk that you have to talk about. Another reason, strategic reason, there's strategies you can do using futures that are nearly impossible to replicate in the stock market. So for example, gold versus silver. There's been a ratio for a long time of gold versus silver. It's been very low in some cases, and it's been extremely high. I think it's been, the range is between like 20 and 90 in the last several decades. So you could trade that spread. You could trade a relationship between gold and platinum, or gold and silver, or platinum and palladium, or the S&P 500 versus the Russell 2000. This is a very pertinent spread now, the S&P 500 versus the Russell 2000. The last time we did a TradeStation seminar, we did it in Florida for one of their master classes, and the S&P 500 was up 9.7%, if I remember correctly, and the Russell 2000, which measures small cap stocks, was up 14.8%. So there's a huge difference there between 14.8 and 9.7. It's about a 5.1% difference. And the reason why is very simple. We have trade and tariff issues here in the United States. People are scared of an all-out trade war. And as a result, the trade issues and tariff issues will affect multinational large-cap corporations that are in the S&P 500 more than they will affect small companies like the Russell 2000. Moreover, most of the multinational S&P 500 companies like Deere and Caterpillar and General Motors, they have a lot of currency risk too. So the dollar affects how they're going to trade as well. The Russell 2000 stocks, they're not as international. They're much smaller. They tend to grow faster too. So they were up about 400 or 500 basis points more than the S&P 500. But what's been happening in the last couple of weeks, if you've watched closely, and this is what futures do, they allow you to track markets and get a little bit more precise on what's going on underneath the surface. So while the S&P 500 went on to make new highs in the last couple of weeks, the Russell 2000 is starting to turn over. And that gap, that 400, 500 basis point move, or excuse me, difference between the S&P 500 and the Russell is starting to narrow, and the large cap stocks are starting to catch up a little bit to the small cap stocks, possibly because the trade and tariff issues will be resolved eventually, possibly because the NAFTA agreement's been renegotiated with Canada and Mexico, and so on and so forth. So again, there's a lot of strategies you can do in the futures markets that just really, they can't be done in the stock market, or if they can, it would cost you a lot of money in margin and transaction costs. Ditto for Brent crude versus WTI crude. WTI is one of the key benchmarks. Brent's another benchmark. You can spread these two contracts. Brent's trading at around $83 a barrel now. WTI is around $73, $74. So there's a $9 or a $10 difference there. A couple of months ago, that was only a $2 or a $3 difference. So as crude has rallied in general around the world, WTI has lagged Brent by just a little bit. And that's a spread that a lot of people trade because it moves. And you get margin offsets because both contracts trade here at the CME Group. You'd get a margin offset, which is a discount on the margins of the two individual legs, which is good. All right, let's move on. So some of the other reasons why people trade futures, many large successful traders and institutions use futures. So some of the largest pension funds and foundations and endowments, they use futures. They use them all the time. They've been using them for decades. Large money managers use them. Some of the most storied hedge funds with great long-term track records use them. Michael Steinhardt used them. George Soros used them in his quantum fund. Renaissance Capital uses futures. Almost every major hedge fund uses futures to some extent that does that kind of trading. There's a lot of hedge fund strategies that have nothing to do with futures or nothing even to do with stocks. But in general, they're used by hedge funds around the world because of all the things we talked about on the first couple of minutes of the seminar. And as we mentioned before, even if you never trade a futures contract, they make excellent indicators and are often the first responder to news events. So, for example, a news event comes out, usually the stock market will react, but the futures will react quicker because it's buying and selling pressure is transmitted into one Globex matching engine, one contract, the futures contract. It's a little bit easier and more sensitive to move a futures contract faster than it is 4,000 stocks to trade on the floor of the New York Stock Exchange or NASDAQ or whatever. It's also much easier to sell short futures. Selling large cap stocks short is easy. Selling ETFs is pretty easy, but selling short, you need a margin account in the stock market. You have to borrow shares, and that will cost you in some cases. And there's an uptick rule when you sell short stocks. You have to have an uptick or an even tick. In futures contracts, none of these requirements are evident. Okay, so this is one of the compelling things. This is what usually gets people to really seriously consider futures because, you know, the Internal Revenue Code applies to every American. Most people don't understand the Internal Revenue Code. I'm certainly not one of those experts, but this is Trader A and Trader B. They both make $10,000. They did it on a short-term trade. We'll say the holding period was very short, under 6 months. We'll just say a couple of days. Trader A makes $10,000, but he does it trading the E-mini S&P 500. Trader B, by the way, this is for U.S. citizens only, active traders, individuals, not anyone else. Pension fund, endowments, they're tax exempt already. This is moot. So Trader A makes $10,000 trading E-mini S&P futures. Trader B makes $10,000 trading the SPY ETF. We're going to assume they're both in a 33% tax bracket. I haven't even begun to memorize the tax brackets. I think the upper tax bracket is still 39%, the highest one. There's a 22 and a 24, I believe. But just assume 33% tax bracket until I can get a ruling from a competent accountant. But just assume for this example, that's it. Trader A is going to be taxed according to Section 1256 of the Internal Revenue Code. Forget all that. It just means the 60-40 rule. Just that means his $10,000 gain, of that $10,000, 60% will be taxed at long-term capital gains, which is much, much lower than ordinary income, and 40% will be taxed at ordinary income, which in his case, the 33% tax bracket, would be 33%. The blended rate would be around 21.2%, so he has to give up $2,120 to the IRS. Trader B's $10,000, he pays ordinary income on the entire short-term gain, 33%, or he'll pay $3,300. It's about $1,000 difference, a little bit more than $1,000 difference. So pay attention. If you're a good trader and you consistently make money, do you want to consistently give more to the IRS? I don't think so. Some people say, well, that's not that big a deal. Well, it is a big deal when you multiply it over hundreds of trades a year, or in the case of some people, they make hundreds of trades a week. And a couple hyper traders probably do that in a day or two. So Trader A, to sum up, keeps 7,800 of his gain. Trader B only keeps 6,700. So it's a nice thing, and not a lot of people know about this. But talk to your accountant first. That usually applies to active retail traders. And it's good. It's not what you make. It's what you take home. That's what matters. All right, so just to sum up here, and then we'll look at some of the questions here. Just in general, why futures at CME? Execution costs. The pound-for-pound futures are one of the cheapest things to trade. Compare your cost to trade futures with anything else, you'll see it's a pretty good deal. Liquidity is unparalleled, especially in the major futures contracts. Just to give you an idea of how liquid the E-mini S&P 500 futures is, trades about 200 billion a day. Now, do you know how many ETFs there are out there? There's 7,100 ETFs, exchange-traded funds out there. They trade about 90 billion a day. So the E-mini S&P 500 alone outtrades all 7,000 ETFs around the world. That's how liquid it is. You have capital efficiencies. Again, reasonable margin, reasonable leverage. They trade around the clock for basically 6 days a week. Strategic reasons, you can do things like spreads that you can't do in the stock market. It's a pure direct play. If you want to trade crude oil or metals, trade the futures contract. They will mirror, they will track the underlying cash commodity very closely. Supply and demand, smoke and mirrors is absent. That's just, there's no accounting issues. We didn't cover that. You remember Enron Corporation and MCI WorldCom? They were accounting issues. You can have accounting issues at a corporation, but you can't with a commodity or a futures contract. The S&P 500 is a $27 trillion market. There's no accounting. It's that the crude oil market is just oil in the ground. No one can manipulate the numbers. Well, actually you could, but it's such a gigantic market, it's mostly a supply and demand market. You don't have to worry about accounting issues or depreciation or accounting fraud. All right. The clearinghouse margining system forces active risk management. Many active traders participate in the futures markets, including large money managers, pension plans. The tax considerations, and it's easier to sell short futures versus stock. So, let's see, do we have any more slides there? Yes. Again, I want to call attention to the institute.cmegroup.com. In general, if you're a seasoned trader, or you're just getting started, and you want to get your learning curve going, CME Group's got a lot of resources. You can go to our website, cmegroup.com. There's a ton of information on it. It's all free. Lots of tools for traders to use, options trading tools, liquidity tools. We also have the CME Institute at institute.cmegroup.com. You have all sorts of course modules, webinars, anything there, any topic from the very, very, very basic to some of the more advanced topics too. So that just about sums it up, and what we'll do now is we'll just take a few questions. We got about 5-10 minutes left. So someone said, yeah, that profit should be per $10,000 profit. Well, yeah, you can look at it that way, but I'm just saying in that example, the traders made $10,000. You can want to say it per 10,000, you can do that, but in that example, they made an actual $10,000. Next question, can European traders trade futures, or also those needed to be cleared by ESMA rules?
They can trade them here.
Yep.
They can open an account.
European traders can open an account and trade them according to Don. Are you going to replay and archive this webinar?
We will, yeah. We are recording. This event will be posted on the TradeStation University page sometime tomorrow morning after we get it cleaned up and wrapped in our introduction music and everything. It will be available tomorrow.
Okay, someone is saying the gold and silver markets are, hold on, it's about gold and silver. I love getting questions about manipulation. I keep hearing the gold and silver markets are heavily manipulated. Are you saying this isn't true? Well, let's say the Hunt brothers tried to do that with silver a long time ago, and that took a huge chunk out of their net worth. It's a big market. Gold's a $6 trillion market. There's a lot of arbitrageurs around the world. If you want to try and toy with them, go ahead. It won't do you too much good. Same thing in the stock market. If the market gets too out of whack from the cash market, index arbitrageurs, and there's a lot of big ones around the world, will come and bring the market back into line, and there ain't a lot of people that have that kind of money to take out those kind of folks. So it's a pretty fair market. I wouldn't worry about manipulation too much. I worry about it more in some of the stocks that I own. But again, ideal. Okay, if there's no further question, oh, someone's got a question. Is there a way to treat my trades as a long-term investment if I incorporate it? Talk to your accountant. I would have no idea. Next one, wanted to address the cost to exit a trade. It's basically same cost to enter a trade. Are commissions round turn these days? Or you pay to get in and to get out?
Right.
Right. That's what I thought. Generally, unless you're really good and you can buy the bid and sell the offer, the only cost will be your transaction cost. But a lot of people will give up the bid and the offer on both sides of the trade. So 2 ticks in most contracts, which, given the notional value, is very, very small. Try doing 1,000 shares of Amazon and see the bid offer spread. What's going to happen when you get in and get out?
Not here. Everything's a day trade here.
Yeah. What is a typical holding period for futures? Don says everything's basically a day trade here at TradeStation. They're very rarely held long term. Most people are day traders. They don't want the overnight risk. Well, unless you have extremely good risk management and very deep pockets, many people won't take the overnight risk or don't want to. Best contracts for new traders? The ones that have, a little bit of volatility, but not too much. Smaller notional amounts, so like crude oil, soybeans and corn have smaller notional amounts. And it's best to start, and they're very liquid too. All right, so Canadian dollars, very low volatility currency market, not too big a notional amount too. Even the S&P 500 is about as large as you go in notional amount, depending on your contract size too, because remember your margin's going to be about $5,500 for a mini S&P. So, all right, well we'll wrap it up here. Thank you all 117 of you that sign on for this thing. Excellent crowd here for a seminar and a fall day. And if you have any questions, feel free to contact the folks at TradeStation or give us a look at the website here at CME Group.
Right. And that's it for TradeStation today. We're spending time with David Lerman this afternoon, and we want to thank everybody for attending. Any questions that you have, please contact a TradeStation specialist. Just give us a call. Go to the TradeStation website. A lot of the answers are there. If they're not, you can get one of our guys on the phone. Thanks a lot. Have a great day, and we'll see you later.